What's going on, guys? It's Matt Fractal back with another video. Today I'm coming to you guys with a backtesting insight video presented by Time Precision FX. If you guys don't know, Time Precision FX is my company slash group slash inner circle. If you guys want to join the Telegram that we have right now, it's free. Links will be in the description. So as you guys can see, we're doing a backtesting insight video. When it comes to backtesting at Time Precision Effects, we stick to the most simple concepts of the X and Y axis on every chart, which is time and price. We will make time our first criteria. The TPFX 12-hour time scheduling. We want to mark out our trading days from 12 a.m. to 12 p.m. daily. These time zones are going to be all New York time. So wherever you guys are in the world, just calibrate 12 a.m. to 12 p.m. Eastern time to wherever you guys are. So if that's in California, India, wherever you guys are, just calculate it to your time. Okay, so we have the Frankfurt session, pretty low volatility. That's from the start of the day at 12 a.m. to 2 a.m. It's a 2-hour session. So if you guys are intraday scalping, you can find something from the 12 a.m. to 2 a.m. time period, but it is usually a low volatile time. London session, high volatility. Everyone knows the London session. It's from 2 a.m. 5 a.m. Eastern time. That's where we get a 3-hour London session, where usually the low of the day is created, or a continuation from the Asia session, or in full terms, just a reversal, high of the day, low of the day. Then we have the London lunch, 5 a.m. to 7 a.m. Another 2-hour session that's pretty low volatility. I didn't put any high, low, or medium because it's just a lunch session. So usually traders go to lunch, or there's some times where the news is around 5 a.m. or 6 a.m. and the London lunch would have some type of nice move. But just generally, London lunch, that's a lunchtime. Go take a nap, go get some food. Yeah. Then we have the New York session, high volatility, just like the London session, another 3-hour time window, 7 a.m. to 10 a.m. New York time. This is where we get either the New York high today, a New York reversal, but most of the time it's going to continue from what the London session did. Then we have the London close session, which is medium volatility. This is from 10 a.m. to 12 p.m. Usually traders get off of currencies and they go over to the indices or the metal markets for the 10 a.m. volatility. But in Forex, you can still get a move with the London close session, 10 a.m. to 12 p.m. All times are in New York Eastern time zone. Refine to your own timing and time zone if necessary, as I said before. Okay, into the charts. Notice in between 12 a.m., which is this line here, and 12 p.m., which is this line here, the most volatility, which is the daily range, is expressed prior to 12 a.m., which is this price action here, and after 12 p.m., which is this price action here. Watch how price slows down in price action. Double entendre. I said that twice. But yeah, watch how price slows down in price action. So low volatility candles. Notice between 12 a.m. and 12 p.m. we have a high being created and then a low, creating the full daily range. And prior to 12 a.m. and after 12 p.m., not really much going on. Always mark out your opening range at Always mark out your opening range price at 12 a.m., which is this orange line going across from 12 a.m. to 12 p.m. This is the New York opening price, and we usually mark it out because anything above this price is usually going to be a premium market, and anything below a discount. The two most volatile times are usually the London. I put up these photos. London. I've never been to London, and the New York sessions. New York here. Yes, I've been in New York. With that being said, it would make more sense as an upcoming trader to focus on time brackets that can produce the most movement for study than eventually taking these setups and reaping the reward. So we want to be trading in the most volatile trading opportunities or trading sessions, which is the London and the New York time zone. That's basically what this slide is saying. Back into the charts. What I have marked out here is that same chart we had a couple slides back. We have the opening. So at 12 a.m., we have the opening price at this candle here. So we mark out where 12 a.m. is, and we mark out the opening price. Then the first session out of those two major sessions, the London and New York, is obviously the London, which is the 2 to 5 a.m. time zone. Then we have that London lunch from 5 a.m. to 7, which is pretty low volatility as well. Notice how we just stayed in this range. And then once we open at the New York kill zone, 7 to 10 a.m., look at the big move that we had to create the lower move for the day for the daily range. That's all of this chart and slide is showing. Now for price, there are multiple arrays, your basic support and resistance price levels. But for the best backtest study / training session, you will notice that the old highs and the old lows will be the best arrays to map out your model. Combining this with the timing concepts can start you off with the introduction to your own personal trading models. The future slides will explain this statement. When it comes to swing highs and swing lows, right? You have these swings right here. Swing lows is when a candle in the middle and then the candle to the left of it has a higher high and the candle to the right of it has a higher high, with one candle being in the middle. This would be considered a swing low. The reason why is because the candles next to it are higher than the middle candle low, which creates a swing low. Vice versa, we have a swing high, which the candle in the middle has a high. The candle to the right of it has a lower. Well, this should say lower high, but technically it has a lower low as well. But it should say lower high. And then on the left side of this middle candle, we have a lower high as well. So this becomes a swing high. It does not matter about the candle being a bullish or bearish candle inside of the 3-bar fractal pattern. As you can see, there's 2 bearish candles here and there's 2 up candles here. It doesn't matter the color or the up or down movement of the candle. As long as let me just finish this. Just make sure for swing lows, the middle candle is lower than the other 2 candles next to it. Vice versa for swing highs. So yeah, swing low, 2 candles next to it, they have, this should be swing high. So this should say, just make sure for swing highs, the middle candle, oh no, this was right. Make sure for swing lows, the middle candle is lower than the other 2 candles next to it. So yes, this is lower than the candle to the left and the candle to the right. Sorry, my slides got me mixed up. So here we're on the hourly chart, and this is still the same chart, but in a different view. So we have this 3-bar pattern that we just went over here. So we have a candle in the middle, which is higher than the candle to the left of it and the candle to the right of it, making this a 3-bar swing high pattern. Here we also have a swing low pattern, which the middle candle's here, lower. To the right, it's higher than the middle, and then to the left, it's higher than the middle, making this a 3-bar swing low pattern. Notice how the London session sweeps below a 3-bar swing low pattern, and the New York session sweeps above a 3-bar swing high pattern. This is an hourly chart. The 3-bar pattern is something that shows up in the market all the time, creating swing lows and swing highs. Above swing highs, we will make the claim that there is buy stops above these levels. So above a swing high, making the claim that there's buy stops. So there's people putting buy orders above the swing highs. Below swing lows, we will make the claim that there is sell stops below these levels. So below a swing low, we're going to make the claim that there's sell orders below that lowest price. This is the most simple way to view your liquidity in the market. Liquidity is the ease of converting an asset or security into cash, with cash itself being the most liquid asset of all. With this being said, when liquidity is traded to, someone is cashing out their money and getting out the market. Using basic understanding, if someone is pulling out money after liquidity is taken, it did not make sense for the market to go in the other direction until the other side of liquidity is traded to. Well, this is what exactly happens in these markets time after time. Again, we're just showing the market in a cleaner view. We don't have those highlighted points. We just have, as we said, we're making a claim that above swing highs, there's buy side liquidity, and below swing lows, there's sell side liquidity. This is what this slide is showing. Prices trading below sell side and reversing, as we just said in that slide prior to this. Would it not make sense if price goes below a sell side liquidity and grab sell orders for it to reverse and go and attack the other side of liquidity, which is the buy side, which it does here. It tags sell side in London, and then it tags buy side in New York. And then what happens after we take the buy side in New York? Price starts to go in the other direction. After we come to a clear buy side or sell side liquidity price run inside of our session times, the next step is understanding the pattern we will be trading to get into the market. It is a retracement entry criteria after liquidity is taken. Very simple concept. And as you get more familiar, you'll be able to get more timed precision. When sell side liquidity, which is a swing low, is traded to, the type of retracement setup you will be looking for is for price to show a strong movement up, like I put it in a layman example. So when price trading up, so looking for is for price to show a strong movement up, which is this move, back above the liquidity. Then as a trader with patience, wait for a retracement back lower, going back to the liquidity. So going, if we're taking the sell side liquidity and we have a movement up, price going back to the liquidity would mean going back down. So that would be, this is your retracement move. So you're looking for a retracement back lower, going back to the liquidity. When we get into a level of 62% to 79% of the range, so the range from this low to this high, we're going down. We're looking for a nice range. Of the range of the strong move up, that will be your best opportunity to get into a buy position during the respective time session. In this example, it's the London session retracement buy setup after taking sell side liquidity. Simple model. So we had that sell side liquidity. We took it here in the time of London session, 2 a.m. to 5 a.m. Then we had that strong move up from this low to this high. And then we have price trading back down into the liquidity. Sell side liquidity is here. So when we're trading back down, this is where the trader with patience is waiting for price to get into a 62% to a 79%, which is right here, retracement. And this would be the best time to buy for that respective session. So you're buying it here. Stop loss below the low. And you're trying to capture a price movement back above the highs, which you can see. So this is the model. It's trading up, back down into the 62 to 79% retracement. You're buying it, and then you're expecting price to continue higher because we already took out the sell side liquidity and we're reversing. When buy side liquidity, which is a swing high, is traded to, the type of retracement setup you will be looking for is for price to show a strong movement down. So we have this layman example here. So price trades down, back below the liquidity. Then as a trader with patience, wait for a retracement back up, going back to the liquidity. So as we trade down the strong price movement, we're waiting for price to trade back up to the liquidity, back up into the buy side liquidity. When we get into a level of 62% to 79% of the range, The strong move, which is from this, it would be from this high to this low. We're trading back up, getting into the 62 to 79% retracement of that range of the strong move. That will be your best opportunity to get into a sell position during your respective time session. In this example, it's the New York session retracement sell setup after taking buy side liquidity. So it's just the opposite of what happened in the London session. We ran above the buy side liquidity here, right? We have a strong move down right here from the New York session. And then when we retrace back up into the 62 to 79% retracement. And as you can see, that would be the best time to sell. And then you would continue your bearish bias back below old lows. We're going to get closer into these setups. So closer look into the retracement setup. This is the London. So this line right here is that sell side liquidity. So when price is trading below sell side liquidity in London, we're expecting on a lower time frame chart. This is a 1 minute chart, by the way. We want price to trade up, show us a strong move. Then once we start retracing back down into the 62 to 79% retracement level, this would be our best time to buy for London. So we have a low, high, 62% to 79% retracement. That's a buy setup. Why are we looking to buy? Why are we looking for this fractal setup? Because we just took the sell side liquidity, looking for price to reverse to go take out the opposing side, which is going to be buy side liquidity, right? New York session, we have this line here, price trades up above liquidity in the New York session, right? We have a nice retracement lower from this high to this low. Then we have a nice retracement back up into the 62 to 79 retracement level. For the New York session, this is the same day on a 1 minute chart. Your best position would be short into the 79 or the 62 to 79% retracement, but a stop above the high, looking for price to continue lower. Why are we looking for price to continue lower? Why are we looking for this bearish fractal? Because we traded into a higher time frame, 1 hour chart, buy side liquidity. Simple. So some key pointers. Having a bias on the higher time frame charts, example monthly, weekly, daily, will better assist you on directional consistency. So this basically means if you're just trading the 1 hour and the 1 minute time frame, yes, you can trade and make money on these markets without having a higher time frame bias. But listen to what I said. Having a bias on the higher time frame charts, example monthly, weekly, daily, will better assist you on directional consistency. So it's just for an assessment. If you see the daily chart doing bearish order flow, trading into bearish order blocks and bearish fair value gaps and continuing lower, yes, when you go down to the lower time frame charts, you'd be expecting for a buy side liquidity run to go to lower and take out sell stops. So having a monthly, weekly, daily perspective will help you better assist on directional consistency. Number two, pairing time, which is the session time. What session are you trading? Either the London or the New York Hill Zone. And price for this model, for this backtesting model, I'm teaching you guys old highs and old lows, which are like pretty simple. It's simple to see in the market. So pairing time, session, and price, old high, old low, will better align your setup with the true fractal nature of price action. Put uh, two does. But yeah, this will better align your setup with the true fractal nature of price action. Why is that? Because the algorithm is only going to trade in a cleaner price action during these higher volatile sessions, which is a London and a New York Hill Zone or the New York session, whatever you want to call it, right? So trading in the time session that you have, London or New York, trading against old lows or old highs, that's going to better align your setup, which the 1 minute or the 5 minute, the lower time frame setup, with the true fractal nature of price action, which is just the true direction of price. Number three, retracement entries are favored over stop raids due to the prior intermediate run or intermediate stop run. So this means when we trade above an old high or an old low on the 1 hour chart, when we go down to the lower time frames, we're not really going to expect another stop rate on a lower time frame. Why is that? Because the intermediate time frame, which is like the hourly or well, in this example, we're going to just stick to the hourly. We have our higher time frame, which is the monthly, weekly, daily, to better assist us on directional consistency. Then we have our hourly chart, which is our old highs and old lows. That's going to help us with the true fractal nature of price action. So when we go down to our lower time frames and we already ran the old high or ran the old low, we're not going to be looking for another stop rate on lower time frames. We're going to be looking for those retracement entries, which I showed you in the prior slides. Last, always urge to frame risk stop loss level under the range low if buy setup is framed, above range high if sell setup is framed. Right? Let's try to go back. Okay, so buy setup. If we're buying in the 79 or the 62 to 79% retracement of this range, low to high, this is the range from low to high. So if you're buying, it says to buy here and frame your risk and your stop loss below this low. A lot of times people try to buy and put their stop loss above this old low, and price just tags them out either with spread or it goes lower inside the retracement. So I would always say frame risk for buy setups below the range low, and if you're buying here, the range your stop loss shouldn't even be that much, right? But always try to put it below that range low. And for the sell setup, if we're shorting in the 62 to 79% retracement level, we want to frame our risk with the stop loss being above that range high, which is above here. So from high to low range, we retrace up into the range, 62 to 79%. We take the short and we put our stop levels above that range high. Okay. So yeah, that was the last slide, I'm pretty sure. That was the key pointers for this whole backtesting intraday, um, whatever you want to call it, time precision setups. I hope you guys got something from this. This was sent to my Telegram channel before this YouTube channel was posted. So if you guys always want to stay up to date with the time precision effects movement, make sure you guys are in the Telegram. So thank you guys again. Hopefully you got something from this backtesting module. Continue to lock in on your setups and your modeling. Um, Coming to the time precision effects and the Matt Fractal YouTube channel is going to be more so of a fractal approach where modeling and systematizing your setups are more important than just the entries itself or um, even the directional bias. What we're going to be doing with our models, we should be knowing what to expect, not what should happen. Like we should know, okay, with this specific model, we're going to have a bearish day, a bullish day. Or with this specific model, we're going to take the buy stops first, and then on a lower time frame, we're going to have a retracement entry or vice versa, which I showed you guys today. So thank you guys for everything. Matt Fractal out.